Friends, have you noticed that the current correction looks nothing like the ones we had before? Seriously, if we look at the recent pullbacks that reached 25-30%, at least they had understandable reasons. For example, at the beginning of the year we started dropping because of Trump's tariff war, which threatened higher inflation. Last year Bitcoin steadily fell by 30% due to high Federal Reserve rates, and in 2022 there were countless red catalysts: high inflation, the collapse of Terra Luna, FTX, and additional pressure from the SEC. But what about now? At this moment, none of these factors exist, and the only thing we have is a decline in the probability of the Fed cutting rates in December. That's all. Yet despite this, retail is selling, whales are selling, and funds are gradually withdrawing capital from Bitcoin and Ethereum. As a result, a kind of snowball forms, pulling everything downward without any specific critical catalyst. That's exactly why I'm saying this drop is unlike the previous ones. Every day we see red candles and the market falling harder and harder. Bitcoin, Ethereum, and all the altcoins simply cannot find support or even begin consolidating. And of course, this demotivates even those investors who entered the market last year. So today, friends, I wanted to figure out why this correction is different from the past ones. We will revisit history and examine what's hiding behind this downturn. I will also outline 5 key reasons for the decline. And no, one of them is not that you personally bought crypto and everything crashed, although in the crypto market anything is possible. And in the end, you will hear a forecast with key positive factors that could lead to an active reversal. But here's another interesting point. The lower Bitcoin falls, the more predictions appear that a bear market has begun. Yet real signals say the opposite. So, friends, during such an extremely difficult period in the crypto market, when we see declines every day and Bitcoin is already trading below $90,000, the most important thing is not to break your long-term strategy and not to follow your emotions. This decline is different from the previous ones. Understanding the whole situation will make it much easier to move forward. The current cryptocurrency market drop is an unusual correction, nothing like the ones we saw in 2018, 2020 or 2022. Now the market is showing behavior that has never simultaneously occurred in a single cycle before, and that's why the dynamics appear so abnormal and create so much panic. Previously, every price decline was clearly tied to liquidity tightening, rate hikes, or systemic collapses. Today, it's the opposite. The Federal Reserve has already moved to a dovish stance, rates are decreasing, and in recent months, over $1.2 trillion has been injected into the US economy. This is the first time in history that the market is falling not on a liquidity shortage, but on an excess of liquidity. This paradox used to occur only during the late stages of bull cycles, but never mid-cycle, which is where we are right now. The behavior of large investors is especially telling. Past declines were triggered by ecosystem failures, exchange bankruptcies, or panic selling from retail. Today, the selling is coming from the largest funds. BlackRock alone took profit worth nearly $1.5 billion in a single week, a record for their Bitcoin-related products. Grayscale continues to reduce its positions, and other funds are recording net profits amid high activity. This is not panic or catastrophe, it is normal capital rotation. But this level of selling has never occurred so early in a cycle. In previous years, funds started exiting only closer to the peak, but now they're doing it early, creating market pressure and triggering a chain reaction of retail sell-offs. Nike. Retail capitulation is one of the major distinguishing features of the current drop. Previously, retail investors would capitulate only after several months of continuous decline, 7 months in 2018, 5 months in 2022, and nearly 8 months in 2014. This time, it took only 1.5 months. According to CryptoQuant, the number of retail positions closed at a loss increased by 280% in the last 30-45 days, and the real fear index dropped to the levels seen during the COVID crash. Retail has never capitulated this fast and this early. Another unique aspect is the record low liquidity in order books. Even with Bitcoin trading above $90,000, total depth fell by 38% during the fall season. Kaiko's liquidity thinness indicator is comparable to the period of the 2022 crash, yet no catastrophe occurred. No exchange collapse, no bankruptcies, no regulatory attacks. Liquidity is shrinking in a calm macro environment, making price movements sharper and allowing even medium-sized sell orders to create large red candles. Altcoins are also behaving differently than before. Despite high network activity, an increase in the number of users, and growing smart contract volumes, the decline in altcoins has been deeper than in previous cycles. Solana is down 35%, AVAX is down 42%, Aptos and Arbitrum have dropped by more than 50%. However, the Ethereum network has increased the number of active addresses by 18%, and Solana's on-chain activity is now comparable to late 2021. Meanwhile, the total supply of stablecoins is growing for the first time in 2 years. In other words, fundamentals are strengthening while prices are falling. Such a disconnect previously appeared only during global crises, not in a rising market. The biggest difference between today's situation and all previous declines is the macro environment. In 2018, the market collapsed due to Fed tightening. In 2020, due to global economic uncertainty. In 2022, due to the most aggressive rate hike cycle in 40 years. Today, rates are decreasing, liquidity is rising, stock markets are renewing local highs, and US regulators are openly pro-crypto for the first time in a decade. Moreover, major catalysts lie ahead. Approval of new crypto ETFs, expansion of derivatives on CME, launch of new products for US investors, and likely a large-scale economic stimulus program next year. This is why the main difference is critical. The market is falling not after catalysts, as it always has, but before them. This creates a paradoxical situation. Fear is at maximum. Downward pressure is high, but the fundamental drivers of future growth have not even been activated. If we view the current movement within the 2024-2026 cycle, this decline does not look like the end of a trend, but rather a deep reset, something that appears only in the middle of long structural cycles. Historically, such periods became the points where the strongest future trends were formed, even though at the time it felt like everything was collapsing. The main conclusion for us as crypto investors is this. When the market falls, due to fear rather than fundamental reasons, it is almost never the end of the cycle, but preparation for the next impulse. We are at a point where the market reacts not to facts, but to emotions. Liquidity is increasing. Rates are decreasing. Regulators are acting in favor of the crypto industry. New ETFs and global economic stimulus programs are approaching. Yet prices are falling as if a recession is hitting the economy. In past cycles, such conditions repeatedly showed the same pattern. When the market falls for non-fundamental reasons amid retail panic, it almost always creates one of the strongest accumulation periods. Today, investors face not the question of where will the price go tomorrow, but whether they can remain rational while the majority acts impulsively. These are the periods that create advantages for those who think ahead, because fear is not permanent, but fundamental catalysts inevitably play out. Therefore, for long-term investors, the key is to understand that current market weakness does not cancel the strength of the overall cycle. This is simply a stage that a year from now will look like an obvious zone of opportunity on the chart, but seeing it in real time is possible only for those who can remain calm when others are losing confidence. The current crypto market decline cannot be explained by a single factor, but there are 5 key reasons that now shape market sentiment. 1. A sharp decline in the probability of a Fed rate cut in December. A month ago, markets gave nearly 95% probability that Powell would announce a rate cut and continue the easing cycle. But recent labour market data turned the situation upside down. New unemployment claims came in below expectations, and average hourly earnings rose more than forecast. As a result, the market sharply recalculated its expectations, and the probability of a December rate cut fell below 40%, the sharpest revision in the entire year. Since the crypto market depends on Fed policy by roughly 80%, this reversal hit market sentiment harder than any crypto industry news. Investors understood that the absence of a rate cut means high cost of capital stays longer, liquidity inflows weaken, conditions for risk assets worsen. First, the market froze in uncertainty, and then it received a wave of sell-offs. However, recent labour data also showed a rise in unemployment. When unemployment rises, the Fed cuts rates. US unemployment for September came in at 4.4% versus the forecast of 4.3%. The difference seems small, but for the market, this is a significant signal. The labour sector is weakening, and when the job market loses momentum, the Fed finds it increasingly difficult to keep rates high. Economic activity slows, consumption decreases, companies begin reducing hiring. And this labour indicator, in my opinion, will become the most important one for Powell at the December 10th meeting. 2. Massive profit-taking by institutional investors. Investors often assume that large funds operate only long-term, but the data shows the opposite. BlackRock sold nearly $500 million worth of Bitcoin in recent weeks, its largest profit-taking ever. And in principle, all major funds were selling during this period. This is not panic, it's cold capital rotation. But it places enormous pressure on the market because, amid thin order books, such volumes push prices down much more aggressively than during calm periods. Funds are rotating into other assets, and crypto becomes a liquidity donor. It's also important to understand that many of these BlackRock or Fidelity sales are actually sales made by retail investors inside these ETFs, not by the funds themselves. The funds are not taking their own Bitcoin and selling it. Ordinary people are selling shares. TS3, record low liquidity on spot and derivatives markets. Order book depth on Binance, Coinbase and Bitfinex has fallen by 35-40% in recent weeks. The market depth index, MDI, is at 2%, equivalent to levels seen at the end of 2022 during the FTX collapse, except now there is no collapse, no defaults, no regulatory shocks, no catastrophic news. Liquidity simply disappeared because market makers became cautious due to uncertainty around rates. This creates an empty order book effect. Even moderate sell orders trigger outsized downward candles. This phenomenon was seen before the 2020 breakout, before the January 2023 reversal, but now it is even stronger. 4. Panic capitulation among retail investors. According to CryptoQuant, the number of retail addresses selling their coins at a loss has increased by 270% over the past month. Meanwhile, the Fear and Greed Index has dropped to 10, a level of extreme fear not seen since the pandemic. In previous cycles, retail capitulation required 5 to 7 months of consistent market decline. Now it took just 6 weeks. This tells us several things. Retail enters the market late, holds positions briefly, exits on the first sign of risk. Such fast capitulation is not a bearish signal. On the contrary, historically, it indicates that weak hands have already left the market and that the market is preparing to find a demand equilibrium. 5. Technical weakness and the breakdown of key support levels. Bitcoin lost the critical $95,000, $96,000 level, which it held for more than 120 days. This was one of the longest consolidation zones in Bitcoin's history, above $90,000. Losing this level triggered a chain of liquidations. Throughout the week, we saw large liquidation events every single day. The liquidation clusters were extremely dense, and once the price reached the lower boundary, a cascade of closed positions followed. In effect, the market was pushed down, and only then did fundamental players begin adapting to the new price. What does all of this mean together? We are witnessing a drop caused not by collapses, not by industry failures, and not by a global crisis, but by the combination of three factors. 1. Sharp revision of expectations regarding Fed rate cuts. 2. Exit of large players from positions. 3. Low liquidity combined with emotional retail capitulation. This is not the type of drop that breaks a long-term trend. On the contrary, such movements typically form a new accumulation range because the fundamental foundation of the cycle remains strong. The US is increasing liquidity. ETFs continue attracting capital. Economic conditions are gradually easing, and therefore, once short-term fear collides with long-term fundamentals, the market will restore balance. Bitcoin price forecast. Now, if we switch to the chart and examine current market structure, liquidity data, demand, and institutional behavior, we can highlight several key zones that determine Bitcoin's forward trajectory. The chart shows that the market has entered a deep correction phase, but the structure of the medium-term uptrend remains intact. The pressure is strong, but there is no critical trend breakdown. Therefore, the forecast is based not on panic, but on the historical zones where large demand typically activates. Check strongest demand zones. 1. $88,000 $86,000 zone. This area contains unfilled spot volumes and levels where funds actively bought dips in the summer. This is the ATET first zone where we may see a reaction from buyers. If sufficient volume returns, a local bottom can form here. 2. $85,000 $83,500 zone. If the first zone breaks, the next strong area lies slightly lower at $85,000 $83,500. This region contains a major volume cluster where market makers showed maximum activity in June. Holding this zone would signal that the uptrend remains intact. Resistance levels $95,000 $96,000. This is the zone where the accelerated decline began. Bitcoin needs to reclaim it before a full recovery can be discussed. $101,000 $103,000 Bitcoin traded within this range for over 100 days. Now it acts as a ceiling, rejecting weak upward attempts. Only a breakout above $103,000 will open the path toward retesting the all-time high. Base scenario based on current dynamics, the base scenario looks like this. 1. Bitcoin forms a local bottom around $86,000 $85,000. 2. Attempts a recovery toward $95,000. 3. The market then determines whether this level becomes new resistance or whether buyers regain control. 4. If lower zones hold and liquidity returns, Bitcoin has a strong chance to retest $100,000, $103,000 in the coming weeks. 5. Otherwise, a long sideways phase may form until the next macro catalyst arrives. Crucially, none of these movements break the global cycle structure. This is a deep correction, not a bearish reversal. Crypto Quant. Signals: are we at the bottom? Crypto Quant suggests that we are close to a bottom. Short-term holders, STH, are currently in a phase of clear capitulation. Looking at the chart of realized losses for STH, investors who hold coins for fewer than 155 days, we can see that the intense red bars have returned to levels typical of major corrections in previous cycles. These same spikes were seen during the major pullbacks of 2021 and mid-2023 during heavy profit-taking phases. Now those spikes are appearing again, and their scale matches historical patterns that often signaled a local bottom. The main problem for STH, the average cost basis of short-term holders is approximately $109,000. Bitcoin is trading below that level. This means the vast majority of recent market entrants are holding losses, which explains the selling pressure. Such behavior is typical for STH and is always aligned with emotional overheating near the bottom of corrections. A critical insight: a spike in realized losses can indicate a bottom only if the market quickly regains levels above the STH cost basis. If recovery does not occur and the price remains below this zone for a prolonged period, history shows only two outcomes. 1. The market enters a deeper correction. 2. Or confirms the beginning of a full bear market. We are now at the exact point where the market is choosing its direction. Where could the true bottom form? In my view, the critical zone where a true bottom may form lies between $78,000 and $80,000. This area has minimal traded volume, no previous accumulation, a void on the chart. Because this region has not been tested or consolidated previously, if downward pressure continues, Bitcoin could move into this zone to perform a final flush, the kind that typically marks the pivot point for an entire cycle. However, I personally will not wait for this hypothetical level. Instead, I will follow the strategy of gradual accumulation, adding positions when possible within these ranges. Final thoughts. Right now, the market continues shaking out weak hands and testing the resilience of every participant. The downward movement is not caused by negative catalysts. Every factor, from retail capitulation to the sharp decline in rate cut expectations, creates a picture driven not by logic but by emotion. In such moments, the most important thing is to focus on facts, not on investor panic. Fundamentals remain strong. Catalysts lie ahead. Fear is highest right before reversals, and this has always been the case. If you agree with this, leave a comment. If not, share your thoughts. Like the video and subscribe to the channel.